On Christmas Eve in 2008, a small electric car company was on the verge of bankruptcy. In the last hours before Christmas, an investor stepped in, saving the company with a $40 million equity investment. Today, over a decade later, that company is the most valuable automaker in the world. In 2023, the company sold 1.8 million electric vehicles, more than any other EV manufacturer. If you haven't guessed it already, the company we're talking about is Tesla. It's easy to forget that Tesla wasn't always a member of the Magnificent Seven, and that once it was a small, growing company. This video will explain how investors can invest in the next generation of Nasdaq-listed companies. The Nasdaq 100 Index offers exposure to technology innovators. But what if investors want exposure to the companies that might be in the Nasdaq 100 of the future? You want to buy Tesla and Netflix and CrowdStrike, but you want to buy them as they were a decade or so ago. Perhaps you could choose early stage companies that you think have the most promise, hoping that they can grow to become as large as Tesla and Netflix are today. This method, of course, carries significant risk. Placing all your investment eggs in a single basket means that if the company doesn't grow in the same way as you expect, you could be out of pocket. Another solution is to buy an ETF that gives you a broader exposure. The Nasdaq Next Gen 100 ETF, ASX code JNDQ, is an ETF that holds companies listed on the Nasdaq from number 101 to number 200 by market capitalization. Think of it as a collection of the rising stars of the Nasdaq exchange. Many of today's largest technology firms like Netflix and Tesla and CrowdStrike all graduated out of the Nasdaq Next Generation 100 index. Since 2010, a total of 80 Nasdaq Next Gen constituents have graduated to the Nasdaq 100. In the case of Tesla, it was added to the Nasdaq 100 in July 2013. Since then, it's returned approximately 2,000%. But investors who held Tesla from December 2012, when it was added to the Nasdaq Next Gen 100 index, would have achieved returns of over 8,000%. Many of the companies in JNDQ are in the early stages of their journey. This is apparent when looking at the research and development investment that JNDQ's holdings are making. Compared to other mid-cap exposures, JNDQ's holdings are on average investing more in R&D and file more patents. This earlier stage of growth means greater risk, but also means the potential for larger returns. Let's have a look at the performance of the Nasdaq Next Generation graduates. Historically, the average returns for companies in the 12 months leading up to graduation have been 82.3%, whereas average returns in the 12 months after graduation was only 12.8%. Performance aside, JNDQ's index is also more diversified relative to the Nasdaq 100 index. The dominance of the Magnificent Seven technology companies has led to approximately 47% of the BetaShares Nasdaq 100 ETF, ASX code NDQ, being invested in the top 10 companies. JNDQ's index methodology has an individual stock cap at 4%. This leads to a much more diversified exposure across the fund. And similar to NDQ, it maintains exposure to innovative thematics, such as the green economy, biotech, and AI. Investors fearing a price correction of the Nasdaq giants, but still seeking exposure to technology companies, could consider shifting a portion of their investment to JNDQ. With its similar methodology, JNDQ offers a straightforward and logical complement to NDQ. A blend of these two ETFs means investors can have exposure to the rising stars of the new economy and continue to hold them as they mature. The blend also means that investors are less reliant on the Magnificent Seven technology companies for capital growth. For more information on the BetaShares Nasdaq Next Gen 100 ETF, check out the fund webpage here.